So where do we go from here? Let's look at our projected returns. One of the if you could project returns perfectly, that would be great. You'd own all the assets in the world pretty soon. Nobody can predict this stuff perfectly. If you could, there would be no return involved because someone would have figured it all out. But anyway, we do go through the exercise. It's useful to have an idea of where returns are going to go. And so for the bond market, it's pretty straightforward. Like I said, the current yield is a reflection of economic activity and inflation. And the current yield is your best estimate of the actual returns of that investment. If you look at the 10-year Treasury bond over history and you take its current yield, so today 1.6%, the best estimate of what you're going to make on that bond is 1.6%. Obviously, if you buy a bond today, a new bond, and hold it for 10 years, your return will be 1.6%, assuming the issuer, doesn't go out of business. That doesn't account for inflation, so your purchasing power may not be there in 10 years. But the point is the return, the best estimate of the return on bonds is the current yield. So what does that mean? We would estimate that returns going forward are going to be somewhere between 1.5 and 2.5, maybe 3% as you get into high yield bonds, some emerging market bonds, those type of things. Even some of those are pushing back up into the 4% range. A little bit more risk, but on the treasuries, yeah, you're going to make between 1 and 2% on treasuries. That would be the estimate from today, going forward. So what does that mean for asset allocation implication? I mean, everything I've talked about so far is just kind of setting the stage for, what do I do? What does this mean? But I think it's important that you understand some basic principles as well as the historical context of what we're talking about. So speaking of historical context, interest rates are extremely volatile. They go up and down almost, much more than the stock market in some instances. It's just you don't really notice it, but they do. They're very volatile. They go up and down. And so what we did was we looked at interest rates over the past 5 periods of rising interest rates. So over the past like 30 years. We didn't go back to World War II, although I have done studies on that before. I can share with you at some other time. But for this purpose of this, I looked at the last 30 years or so. So that encompassed 87, 88, 94, 95, 99, 2000, 04 to 06, and 2015 to 17, where we saw multi-year periods of sustained rising interest rates. And what did that mean for the bond investor? So I looked at some standard, Vanguard mutual funds, short-term bonds, intermediate bonds, long bonds, and then the aggregate bond index. And I said, well, what was the return on those? And so when we look at the short-term bond, we see the average return in those periods was right about break even. It was minus 0.1%. So pretty much break even. The intermediate bonds was about minus 1, about 1.5%. Same thing with the total bond market, which is essentially an intermediate bond fund. Now, as you got out to the long bonds, the return was about minus 4%. As I said before, on that seesaw, those long bonds, you're going to get whipsawed a little bit more. So we tend to stay away from the long bonds anyway. But those were the worst returners at minus 4.5%. I also thought it'd be useful that the average return, when there was a loss in the stock market during that same 30 year, the average loss for the stocks was about 17% during that time. So when you're looking at a year where bond loses money, even the long bond at 4.5%, it's like a fourth of what the average loss of a bad year in the stock market is. So yes, there is the possibility for some losses, but it still pales in comparison to a stock market loss. The other thing is you look at during that period, what was the worst sort of 1 year? What I told you before was the average loss. When there was a loss, what was the average loss? So the worst year for all those was also significantly less than anything in the stock market. As you know, that would have one of those periods pulled in 2008, where you had a 37% decline in stocks one year. The worst bond year was -6% on the long bonds. So, yes, there is some possibility of declining returns, but nowhere near what happens when the stock market declines. So also looking at those historical periods, the majority of the returns from bonds come from the income. And granted, at 1.6%, you're not making a whole lot of income, but also when you look at it, the income, as interest rates go up, you're collecting more income, while the price interest rates going up hurts the price. Assuming you're reinvesting at those higher bonds, which we do, your income is accumulating more. And so the higher income you're getting paid tends to offset some of the price decline. In fact, the way to look at bonds is each bond has a maturity. So let's say you buy a 10-year bond. If you need the money in 20 years or never, like the majority of it, so if your time horizon, meaning when you will probably need the money, exceeds the maturity of the bond, fear not for rising interest rates. If your time horizon is 15, 20, 25 years, and you own a 10-year bond, there's nothing to fear, because any price fluctuations you have will be more than made up for by the higher interest rates, the coupon, the money that you're receiving as interest. Now, if you need the money from a bond in, say, 2 years, don't buy a 10-year bond. So if your time horizon is shorter than the maturity of the bond, you have the possibility of incurring permanent capital loss. So that's why we tend to keep the maturities on our bonds fairly short, to minimize the possibility that someone would need the money in a shorter time frame than the average maturity of the bond. I know that's a little bit confusing, but just keep in mind that if your goals are long-term or medium-term or whatever, and your maturity of your bond portfolio is shorter than that, you should not be overly concerned about rising interest rates for bonds. Also, in addition to the income, bonds are really in the portfolio as a ballast to stocks, a shock absorber, if you will. As stock markets go up and down, typically, historically, and this relationship has continued to hold, stock markets decline, bonds do very well during that time period and apply a buffer to the returns of the stock market. If you can absorb the decline of stocks, there's nothing wrong with having majority stocks in your portfolio. I personally carry about 85% stock. Studies have shown anything above 85% is actually suboptimal, because when markets do decline, if you have some bonds in your portfolio, then you can use those to buy stock when markets are down. But anyway, having a bunch of stock in your portfolio, there's nothing wrong with that. We put the bonds in there because either people's risk tolerance, they can't sustain that volatility. It makes them nervous. They panic. Or number two is they need the money in a shorter time horizon than we feel comfortable with stocks. But that's why the bonds are in there. If they make some income, that's great. If they pay some interest, that's great. But we don't put them in the portfolio to quote, live on the interest. In fact, with tax rates the way they are, interest being taxed at ordinary income rates, that's generally a pretty poor strategy to do unless you're using all tax-free bonds, is to try to live on the interest from your portfolio. You'll lose so much of that to taxation, especially if you're trying to generate, 100,000, 50,000, whatever of interest income. It's a very poor strategy. So given all that, what do we do? So in our bond portfolio, we do have a little bit of higher yielding securities, some high yield, but most of our bond portfolio is high quality bonds. We also have treasury inflation protected securities in there, TIPS that react positively to rising inflation, not necessarily interest rates, but inflation. In fact, last year our TIPS made about 12%. So for a bond, that's very, very, very strong. We also keep the maturity of the bond portfolio very short, such that our largest bond position is actually a short-term bond position. It helps protect us against rising rates. So what's the overall implications of that is we still believe that bonds have a place in the portfolio of most investors, either to mitigate their psychological risk, their ability to withstand psychologically declines in the value of their portfolio. Number two, from a practical standpoint, because they can't afford to have a giant decline in the portfolio because they're taking money out. Bonds provide that ballast. And as I've demonstrated, just because interest rates are going up does not mean it's going to be a disaster for the bond market. So we recommend not doing a wholesale change of your portfolio just because interest rates are rising. We have a plan for this. We've studied this. We know how this works. But if you have individual questions on this, please reach out to your advisor, and we'll be happy to walk through it and look at your individual situation to see if any change is warranted. Okay, well, I hope you found this informative and that you enjoy the rest of your week. We'll be back with another episode of this, some informative information next week for you.